Loan modification. If you are struggling to make your monthly mortgage payments, you may be wondering if there is a way to modify your loan terms and avoid foreclosure. A loan modification is a process that allows you to change some aspects of your original mortgage contract, such as the interest rate, the loan term, or the type of loan. A loan modification can help you lower your monthly payments and make them more affordable for your current situation. However, getting a loan modification is not always easy or straightforward. You need to meet certain eligibility criteria, provide documentation of your income and expenses, and negotiate with your lender or servicer. In this post, we will provide a list of each of the steps in loan modification and a blog title for each of them. Step 1. Talk to your lender or servicer. Also see how to communicate with your lender or servicer about loan modification. Link in the description. The first step in the loan modification process is to contact your lender or servicer and explain your financial hardship. You will want to speak with someone in the loss mitigation or loan modification department, who can review your situation and tell you what options are available for you. You should also ask about any programs or requirements that apply to your specific loan type, such as Fannie Mae, Freddie Mac, FHA, VA or USDA loans. Step 2. Gather and organize your documents. Also see, what documents do you need for a loan modification? Link in the description. The next step is to prepare and submit the required documents for a loan modification. These may include a hardship letter. A hardship letter is a written statement that explains the financial and emotional difficulties faced by an individual or family. It is usually submitted to a lender or creditor when the person is unable to meet their financial obligations, such as mortgage payments, credit card debt, or medical bills. The letter should explain the specific circumstances that led to the financial hardship, such as job loss, illness, or divorce. It should also outline the steps the person is taking or is willing to take to address the situation, such as seeking employment or working with a credit counselor. A well-written hardship letter can help the person avoid foreclosure or bankruptcy and may lead to more favorable terms from the creditor. Proof of income. Proof of income is a document or set of documents that shows how much money an individual or a household earns. It is often required in various situations, such as renting an apartment, applying for a loan, or obtaining government assistance. The most common forms of proof of income include pay stubs, tax returns, bank statements, and employment verification letters. The purpose of providing proof of income is to ensure that the individual or household has the financial means to meet their obligations. It also helps the lender or landlord to determine the amount of credit or rent they are willing to extend. It is important to have accurate and up-to-date proof of income to avoid any delays or complications in obtaining financial services or securing a place to live. Proof of expenses. Proof of expenses refers to the documentation or evidence provided by an individual or business to support the expenses incurred during a particular period. This documentation is usually required to claim tax deductions or reimbursements from an employer or a third party. Proof of expenses can include receipts, invoices, bank statements, credit card statements, and other relevant documents that show the date, amount, and purpose of the expense. Accurate and detailed proof of expenses is crucial for maintaining good financial records and avoiding any potential legal or financial issues. A budget. A budget is a financial plan that outlines an individual's or organization's expenses and income over a specific period. It is an essential tool for managing finances, as it helps to monitor spending and identify areas where costs can be reduced. A budget typically includes fixed expenses, such as rent and utilities, as well as variable expenses, such as food and entertainment. It is crucial to create a realistic budget to ensure that expenses do not exceed income. By sticking to a budget, individuals and organizations can save money, pay off debts, and achieve financial goals. A budget can be adjusted as circumstances change, such as an increase or decrease in income or unexpected expenses. Overall, A budget is a vital aspect of financial planning and can help individuals and organizations make informed financial decisions. A completed application. A completed application is an important document that provides information about an applicant's qualifications and suitability for a particular job, program, or opportunity. It typically includes personal information such as name, address, and contact details, as well as educational and professional background, work experience, and skills. A completed application also often requires additional information such as references or transcripts. Submitting a complete and accurate application is crucial for ensuring that an applicant is considered for the role they are applying for. It reflects positively on the applicant's attention to detail and professionalism, and increases their chances of being selected for further consideration, such as an interview or admission to a program. You should make copies of all the documents and keep them in a safe place. You should also send them by certified mail or another method that provides proof of delivery. How COHFP can help. If the traditional ways to avoid foreclosure do not work for you, we have options. Discounted realtor services. Pay less, and maybe even avoid real estate fees completely. In-home counseling. We offer in-home consultations to discuss your unique situation and explore potential solutions. Home repairs. Through our Home Partnership Initiative program, we can assist homeowners in making necessary repairs to their homes, which can increase the value of their property and help secure a better sale price. Fast track. You may have an urgent matter that simply cannot wait. Fast Track, the Priority Assistance Program, allows proper handling of urgent matters that you may need assistance with. Call 888-325-CHFP or email gethelp@cohfp.com for more information. Step 3. Review and understand your options. Also see how to choose the best loan modification option for you. Link in the description. Once you submit your documents, your lender or servicer will evaluate your eligibility and offer you one or more loan modification options. These may include lowering the interest rate, extending the loan term, changing from an adjustable rate mortgage, ARM, to a fixed rate mortgage, reducing the principal balance, forbearing some of the payments, adding the missed payments to the end of the loan. You should carefully review each option and compare how it affects your monthly payment amount, total interest paid, loan balance and payoff date. You should also consider any fees or costs associated with the loan modification, such as closing costs, appraisal fees or late fees. Step 4. Accept or negotiate the offer. See also, how to accept or negotiate a loan modification offer. Link in the description. If you are satisfied with the loan modification option offered by your lender or servicer, you can accept it by signing a new agreement that outlines the new terms of your loan. You should read the agreement carefully and make sure you understand all the details and consequences. You should also keep a copy of the agreement for your records. If you are not satisfied with the offer, you can try to negotiate a better deal with your lender or servicer. You can explain why you think the offer is not enough to help you afford your payments and what changes you would like to see. You can also provide additional information or documents that support your request. However, keep in mind that your lender or servicer is not obligated to agree to any changes and may reject your counteroffer. Step 5. Comply with the trial period. Also see how to succeed in the trial period of a loan modification. Link in the description. Before finalizing the loan modification, your lender or servicer may require you to go through a trial period of 3 to 6 months. During this time, you will have to make reduced payments according to the new terms of your loan. The trial period is a test to see if you can afford and sustain the modified payments. If you fail to make the payments on time and in full, you may lose the chance to get a permanent loan modification. To comply with the trial period, you should make sure you know when and how much to pay each month. Set up automatic payments or reminders to avoid missing any deadlines. Track your payments and keep receipts or confirmation numbers. Contact your lender or servicer immediately if you have any issues or questions. Step 6. Finalize the loan modification. Also see how to finalize and maintain your loan modification. Link in the description. If you successfully complete the trial period, your lender or servicer will finalize the loan modification and make it permanent. You will receive a new loan statement that reflects the new terms of your loan. You should review the statement and make sure everything is correct. You should also update your budget and financial plan to accommodate the modified payments. To maintain your loan modification, you should continue to make the payments on time and in full. Monitor your credit report and score for any errors or changes. Seek financial counseling or assistance if you face any new challenges or difficulties. Avoid taking on new debt or refinancing your loan without consulting your lender or servicer. Colorado Home Foreclosure Prevention, COHFP. Arrange free housing counsel. If the burden is too much to handle on your own, Colorado Home Foreclosure Protection can help. We believe that during the initial home consultation, you'll feel huge relief. Happiness will start to set in immediately. Reach out today. Contact us today. Thank you.